All right, good evening, everybody. Welcome and welcome to our first webinar of the year. You know me, totally nervous. Nah, I'm good. Welcome to my new office. Below me there, you've got Dave Windler there in his new office. How you doing, Dave?
Good, thank you, Steve. Hello, everyone.
Great to have you all on board. A super topical subject tonight. I was just thinking about this, the preamble and all that. Like 31 years ago, I bought my first investment property for $27,500, put the deposit on my credit card, went to my bank, and they just gave me the money. Every year after that, it's got harder and harder. There's been bigger numbers and more money, but it's been harder and harder to actually get the money. And yet there's the same amount of money sloshing around in the market. It's got to go somewhere. And so mortgage brokers were invented out of need and trust and a little bit of wonderfulness. You know, they were melded together and created into this beautiful picture of a man you see underneath my photo there, and to assist us in taking the bank's money off them so that we can make some money with it. Now, we're going to talk about all things banking, funding, finance, broker, a little bit about property, and a little bit, you know, because it's just going to be like real property investment. It's going to be like 85% finance and the rest of it's houses. But the first thing I need to say tonight as a wee bit of housekeeping is the exits are, that this is not financial advice directed specifically to you. This is classroom advice. This is very general. And if you need individual advice on finance and funding, I highly recommend Dave and his team nationwide of the Mortgage Supply Company. We'll give you the links and the access and the bits and pieces so you can get directly in touch with them after the webinar. But all we need to do basically say is if you need financial advice, see a financial advisor. Dave and his team are financial advisors. That about right, Dave?
Bang on the money.
Super. Second thing I'd like to say is we do have a question and chat section to the right there, and love to see you chuck in the any questions you've got as we go along, or hold your questions and we'll ask for a pile of them in between or at the end. Love to sit here and answer questions all night because you know, I just don't have a life really. You know, I'm stuck in this room all day. And actually, I think like the lending market is actually got super interesting at the moment because it's very different to how it was previously with fiscal policy and the way banks are working, bank liquidity, new rules, new laws, new legislation. It is actually getting, you know, pretty interesting. So, so this is our finance webinar for 2024, whole pile of new information. Obviously, we've got beautiful Mr. Dave Windler here, Astute Financial New Zealand Advisor of the Year 23. What's that about? That sounds flash, mate.
Oh, just a little gong, mate. I think we're part of a wider aggregator group called Astute Financial Management. So there was a wee award picked up in Fiji towards the end of last year. So I was really, really proud of that. And I've been doing this for a little while now. I mean, it has become rather challenging. See, that profile pic was only taken last week, and since then,
You're 22 in that photo, eh?
I've deteriorated. New ones are coming through shortly. But yeah, I guess, you know, my background prior to doing all of this was in sport and coaching. I worked in cricket for a decade, sort of teaching teachers how to teach cricket and coaches how to be coaches, and doing elite performance within the junior ranks. Really enjoyed that, and just needed a wee career change down the track. And like to think that a big part of what we try and do here is empower people and educate them, and that's a big, you know, motivator for me for being here. We're going to talk through some stuff that hopefully is of benefit to all the people tuning in, and they can have a think about their situation and get to understand it a little better. We're going to get brave and try and predict the future as well, Steve. That could get interesting.
Yeah.
Yeah. I mean, it's challenging. I think, you know, within the last sort of, I'm going to say 4 to 5 years, that the screw's been turned little bit by little bit, and there's been more and more challenges put in front of us to navigate on behalf of our clients. So I think that very fact has meant that the market share that mortgage advisors had keeps increasing. I think it's probably sitting around 60%. Yeah. You know, branches are closing down, expertise is leaving banks and ironically becoming a broker. So a lot of people look to get that advice, and particularly once things get complex and investor lending can get a bit complex, that's when people come for help, and that's what I specialize in. It's always enjoyed dealing with investors, whether we're through the years.
Investor lending is very different to owner-occupier lending.
It's got more numbers in it. I think it's as simple as that. You've got owner-occupied lending. You've got one loan requirement. You've got potentially either PAYE salary or self-employed. It's just give me one of those and I'm happy.
Yeah.
But give me a big portfolio that's got 15 properties in it, 4 or 5 different lenders. You've just got more numbers in it. So the maths and the options just becomes more complex. And I think what we try and do here is not just provide a solution, but try and provide the very best solution. That's incorporating all of those numbers and pushing them around. So we're not just looking at what the next purchase might look like. It's, well, what does the one after that look like as well? And try and be a strategic partner.
Yeah. And basically being the opposite of a hospital pass, not painting anybody into a corner. I work with a few of your advisors around the country, but there seems to be, for the benefit of the client, the ability to extrapolate assets out of a portfolio and use that resource for its best benefit. And I think right now in the market they're in currently, where we're quite obviously in unless you believe ANZ, we're in an environment where interest rates are going to start to cool a little bit better, be a little bit more positive for investors for cash flow. And we're in an environment where the property market is, by all accounts, either going flat or starting to warm or starting to bubble or, move along, progress out of a bust cycle. We're kind of in a place where I'm sitting there talking to people every day about, take your income, turn it into assets and sit on it. In 3 or 4 years' time, you're going to look like you were really brilliant. You timed it perfectly,
Well, I think if you remove the DTI out of the mixer, right, which we know is coming, which could have an impact. There's the potential through the course of the year for, a few things to be put in place that we've been waiting for a little while. Interest rate deductibility, coming hand in hand with DTIs, is an increase in LVR. If rates start to soften in any way, that'll give the general public some confidence, and they will start to hop on board with property again. So I think for me, as we sort of properly hit the start of the year, I know it's February, but you have your summer holidays and the kids are going back to school, and then you have 2 short weeks if you're up here in Auckland. We're only really starting to get into our stride now.
Yeah.
And I think this is about positioning yourself for the year ahead and going, am I or aren't I? Am I in or am I out? And if I'm going to be in, am I going to be in before everyone else is?
Yeah, and I think we've got a little bit of time for that. But what we don't have time for is to observe the market moving and then react. So I think that broker numbers and how busy you are is the precursor to how busy the market's going to be, because people need to get pre-approved, first quarter of this year really to capitalize on this year's market.
This week's been real busy, mate. I think we're on the coal face, so we're obviously we've always got applications going through the pipeline, but this week particularly lead inquiry has been well above average.
Yeah,
from a whole variety of places. Yeah,
fantastic. So. Yeah, you've touched on a lot of factors there, but let's roll into it.
Sure.
Let's have a quick look at the slides that you've put together and bits and pieces.
Go back a couple.
Yeah, that's the wrong where we are. There we go. Yeah,
there we go. I've got my crystal ball out.
And I watch a lot of the commentary from economists and from OPS and from myself and from everybody else. And the only person in the country who's really got a clue is Adrian Orr.
You sure about that?
But it's a tough out. I've met the guy. He's a really smart dude.
Heck yeah.
But in reality, it's a bit of a toss up. And as I said earlier, ANZ thinks that the official cash rate's going to go up. They are an outlier. They're out there on their own. And ASB, BNZ, Westpac, Tony Alexander, absolutely everybody else thinks that the next move by the official cash rate is to go down, and not to go down hard or fast, but just to cool the market a little bit. Where do you see it?
Yeah, well, in preparation, I took the liberty this morning of taking a look at 6 different places and got my horoscope
Right.
for today. And 3 of them said that I was going to have a bad day. 3 of them said that I was going to have a good day. And one of them said, quite literally, that I would have success in business today involving writing or speaking. It may come my way.
Right.
So one out of 6 got it right. And I think it's pretty much how I feel about all of the OCR predictions that are going on with this. They're all over the show. The one for me was the one that came out recently, which is the survey of what's expected to happen with inflation. And most of the feedback around from that survey was around an expectation that we'd start to, hit our straps with inflation. It would start to come closer and closer to the Reserve Bank band. It is a survey apparently the Reserve Bank listened to. Then you've got still a whole heap of stuff going on, which is saying, actually hold the phone. It could go up again. If I'm going to be a betting man, I'm going to say it's going to stay the same. I think we're going to get an on-hold call from the Reserve Bank on the 28th, but within the monetary policy statement that they will make, they're going to say, let's be careful out there. It's not going to be dovish. It's going to be bearish, but they'll keep it on hold. I just can't see them. I can't see them raising. See, the thing we have in New Zealand is that most of our decision making by the Reserve Bank is based on historic data.
Yeah.
All right. So you look at a quarterly, look at an inflation statement which says we're sitting at 4% or whatever. That's based up on the inflation rates over the previous 4 quarters.
Yeah.
Now, if you were to take the last quarter and multiply it by 4, you're going to get pretty close to to 3%. So quite often I feel that we're dealing with data that's actually old.
Yeah.
So, and then, so I think that hopefully that's going to be the case, because I think that because we deal a lot with historic data, we can hang on to something for too long, or we can, we know that when through COVID's times where, we look back on that and go, gee whiz, the OCR was too low for too long. So perhaps some of the decision-making here is not as nimble as it might be if we were utilizing, instead of quarterly data, monthly data, and we can be a little bit more nimble.
Yeah, but that's the thing. The OCR has always been a really blunt instrument. And,
Sure.
The only real direction they've had is don't make us a banana republic and keep inflation under control. And inflation has seriously become under control. I would probably agree with you that they'll keep it the way they are, but if they don't, it'll go down. I can't see it going up. There's just going to be too much bad press about cash flow crisis and, people stealing food from Pack and Save to feed their families. And, you can see the front page of the Herald just writing itself after that. I think it stay the same or go down personally. And I think that the precedent is that the official cash rate will start to come down. We'll start to see some competition in rates between banks as they try to compete for market share, predicting that the OCR will come down. And the reason I say that is because I like to watch what banks are offering for 1, 2, 3, 4, 5 year rates. And at the moment, they're trying to be really competitive for 3 and 4 year rates, which, and banks are vampires. They want to suck everything out of every mortgage. I could say that. You've got to work with them. They want to suck everything out of everybody they possibly can. So if they really want to push you to the 3 and 4 year rate, in my mind, they believe that the 1 and 2 year rate's going to be better, and they're going to be winning if you take a 3 or 4 year rate at nearly 7%, because you might be at 5.5%, 6% within the 2 years. Do you know what I mean?
Yeah, absolutely. And it's signaling with what's going on. This almost battle between the Reserve Bank and the markets, because the markets are pricing in drops in rates, right? They're pricing cuts, and the Reserve Bank's going, hold on a sec, you might be jumping the gun a little bit. If the Reserve Bank does hike on the 28th, it will then also put it out of kilter with basically every other central bank.
Yep.
Yeah. And I think that I really think quite strongly they're going to hold on the rate, and there's going to be a lot of tough talk about it. Don't expect any cuts any soon, but we're just going to hold for the moment. Almost seems a sensible decision to me too, because if they squeeze any more, the consequence of all of this, of course, is unemployment.
Yeah.
That's what happens. That's what they're waiting for. is to get employment figures at the right level, so they go, okay, we've done our job now, but that means there's a heap of people out of work.
Yeah. So the proof of the pudding is normally not what, talking heads like us on a webinar say, but it's what we do. So let's assume that you've got $500,000 on a rental property and it's going from fixed to floating in the next couple of 3 months. What are you doing with it yourself? What sort of rate are you putting $500,000 back and refixing it at right now?
If I was personally making that decision, I'd probably go for 12 months.
Yeah.
All right.
Yeah.
I mean, certainly I had a really nice conversation with a client 3 days ago, and it was owner-occupied lending, a reasonable amount, so we were looking to split it into thirds. And we had distinctive conversation around, you could either fix for 6 months, 12 months, and 18 months, split it into 3, or you go 1 year, 18 month, 2 year. Which one do you want?
Yeah. See, that's an important point that I think a lot of people miss. They look at $500,000 and they go, what do I have to do with the $500,000? And
cut it up.
One of the brilliance of ringing your broker when you go to refix is that they can suggest things like cut it into 2 lots of 250, puts one on 6 months, one on 12 months, and you're diversifying the interest rate that you're getting when that becomes unfixed and goes back to floating. Because the biggest shock you get as an investor, and trust me, this exact scenario has happened to me recently, is I fixed for 2 years at 4% and it came out and went to a floating rate at 8.5. And that really hurts. Trust me, that one leaves a mark. Yeah, that tickles.
Yeah, and I think the strongest thing I'd put through to folks listening tonight is that if you've got a rate coming up for a refix, don't just refix. The banks are making it easy for you as well, because you can hop onto your internet banking, click a button, and it's done, right? Yeah. But it's an opportunity to review your overall position. Where am I at? Where are my goals at? What rate is going to be aligned to other decisions that I'm having to make? Because particularly when there's a lot of confusion and varying, a lot of noise. One thing that you can be certain is about what you're doing and what your plans are and what would happen if you took a certain rate option. So you really need to bring everything back close to home and make these decisions, based on what you do and what you know, rather than, listening to too much of the noise. And cash flow is a massive issue for a lot of people. And sometimes, they don't execute the options that they can to improve their cash flow. So, the big one that people miss quite often is not just when their refix rate up, when their interest only expires.
Yeah.
The number of people who miss that, and all of a sudden they roll onto a 22-year principal and interest term on a higher rate, that really hurts. So restructure, we're doing a lot of restructures, lengthening out loan terms, interest only applications, and we're okay and comfortable with that as long as we're managing the future relationship where we're having a good conversation where, once rates come down, let's shorten the term back up. Let's look to make extra principal payments. But when cash flow is tough and tight, we'll do what it takes to get through that. Because I believe, when you're looking to try and pay a mortgage off, it's a journey with stops and starts.
Yeah.
You don't have to have your foot on the accelerator in exactly the same way for the whole journey. You can take your foot off, you can put your foot down, as circumstances dictate. As long as you still get to the end line, that's all that matters,
Yeah, and I absolutely believe that, because when you're in a high interest rate environment, a lot of investors aren't acquiring new assets and putting them in their portfolio. They're just maintaining, they're paddling, they're staying on top of the water. And then what they need to remember to do when interest rates come down and values shoot up again is to accept the lower interest rate but pay the old amount and overpay their mortgages to give themselves some protection there. And that gives you a redraw facility, gives you financial resilience. And that's what you use, and that's what a lot of people who obviously follow my page did 2 or 3 years ago. And some of them are still on that when they fixed for 5 years at under 3%. As I very loudly begged / recommended people to do. So what sort of rates are people getting right now? What sort of rates have you seen come through the office that you thought, that's actually not too bad for now?
Yeah, the sort of 6 months and 1 year is all sitting around that 689, 699 mark. So, if I would suggest that's where the rate offering is competitive. If you're getting a rate on those terms that have got a 7 in it, then there's a little bit of squeezing to do. And most of the stuff we're doing, to be honest, at the moment, Steve's probably operating around that 1 year mark. Yeah, and we're just making sure it's under 1%, under 7%, and then that's where our middle ground is at the moment.
Yeah, and refix options. Obviously, if people are in a bit of financial pain. You've mentioned going interest only. There's post COVID, there's no sort of like bad cloud of juju around going interest only. It's just another tool like any other. It's not like you're throwing the white flag up the bank, is it?
Yeah, I think folks got to realise that, generally speaking, going interest only involves a full application, right? So there's some irony with this, Steve, is that there's an expectation in order to easily get interest only that your servicing calculations work, which therefore that must mean that the servicing calculations work on a principal and interest basis. Yeah. So, but we have had regular success dealing with the banks. I don't think they've been unfair with how they've looked to go through their processes. Even if the servicing doesn't quite work, we're still getting things done on the basis that it's the right decision for the client, and a sensible decision for the client. Sometimes we have to smack the bank around a bit to get it done, because what we don't want to do is get it done through the bank's hardship team. That's our last resort. The hardship process kind of takes it out of our hands a little bit, and generally speaking, the client only gets that interest only for 6 months.
Yeah,
we want to do it so the client's getting the interest only approved for a number of years, so we get on safe ground for longer.
Yeah. I mean, I've got a mortgage at the moment that I'm pretty sure the bank's forgotten about, that I've had interest only for nearly 10 years. Don't tell anyone.
Yeah, no, I won't. I promise I won't. There's some reasonable offerings out there. TSB came out a few weeks back, and they've got a 10-year interest only offering.
Yeah,
if you want it. A couple of the New Zealand banks at the moment are doing 1% cashback, which can be useful. If you're coming off, one of these really good rates onto a high one, you get the opportunity to kind of, put the effort into shift somewhere else and pick up 1% cashback at the same time. That's going to put a few grand in your back pocket, which you can utilize to assist you with servicing. So, there's options, and I think we've just got the servicing rates are what hurts. That's what hurts more than anything at the moment, and that's the major stopper for people moving forwards. They're sitting around 895. That's what you're getting tested at. All your existing debt gets tested at using the same rate. So most of our time we're looking to work around servicing issues to make things happen for people.
Yeah, so proving better income. Showing it with all of the stuff that we're going to need to do when we start talking DTIs in sort of June, July, which is when it sounds like it's going to start coming out, which is pretty much what we're going to talk about next. So,
so the basics of it, 6-to-1 for owner-occupied lending, 7-to-1 for investors. Key thing here to realise is that the banks are going to get given a 20% speed limit for this. So at the moment, that's a fair increase on the speed limit. What we don't know yet.
That's totally clear for everybody, except for everybody totally doesn't understand what that means. But if I have $100,000 income, I can borrow 6 times that, so $600,000. It doesn't mean that I have to buy a $600,000 house, because I might have 150 grand equity or deposit, so I could buy a $750,000 house. And for investors buying investment properties, it's 7-to-1. So $100,000 income gives me $700,000 lending. So it starts to become a little bit more complicated, doesn't it, when they're calculating the family home and a batch and some car lending and 2 rental properties and some credit card debt, doesn't it?
Yeah, it sure does. And the next couple of slides will kind of show a couple of examples of how to work out a DTI. And there's still so much more detail to come, Steve. There's things we are... we're guessing at some of this stuff. So the 20% speed limit will mean that, that for whatever the bank lends within the DTI parameters, they can lend 20% of that outside of the DTI parameters.
Yeah, so basically 6-to-1 is, or 7-to-1 if you're an investor, is what most of their lending is going to be. but they're allowed to do some lending that is not that. So you'd be lucky to get it if you did, but basically you got to keep within that. And there's still 3 rules there too, isn't there? It's not just DTIs. So you've still got to be able to prove that you've got a 20% deposit in either cash or equity in other properties. You've still got to go through sensible lending criteria. So cash flow, you've still got to be able to prove that you can service the lending and pay it back. And then third is the new bit, is the debt to income, which is kind of a speed bump or a maximum cap on the amount of debt that any investor can hold. So do you think that there'll be a time where investors will have 5 or 6 properties, they can't possibly buy any more, so instead they'll sell one property that's not performing to buy one that is performing?
Yeah, quite likely that they will, to be frank.
Yeah.
Steve, people are doing that now. I think one of the things that high servicing rates has encouraged is for investors to really look at what they've got and ask themselves the question, is it good enough?
Yeah.
So I've certainly been involved in a number of transactions where, investors go, oh, actually, that one's really poorly performing. I've now become more educated as to what I could buy, and I'm going to get rid of that in order to buy that. So yeah, a lot of that stuff's happening now. The key here, or the upside for investors, is the LVR limit's going to shift up 5% to 70, so that's useful.
Well, it's useful if you've got 5 or 6 properties. If it's one, it means about 30 grand's difference to you, doesn't it?
Yeah, you're right. But I'm happy to take any good news, mate.
Well, it's great for me. I'm loving it. Yeah. No, I don't need to be a cup of cold second, but yeah, okay.
One of the things I'll just touch on with the speed limit and sort of that 20% that the banks are going to be able to lend outside of those DTI parameters. We don't know yet what will qualify for them to be able to do that, but it's got to be servicing.
Yeah.
Right. So
they're going to give you a little bit of a gem with new builds, I would imagine, as well, don't you think?
Possibly. So we don't know that yet.
Yeah.
We don't know that yet, but I think servicing is going to be the key. So it's a little bit like with first home buyers at the moment, where the speed limit's in play for them. In order to access the funding, it's got to be a live deal. Sometimes you've got to be an existing customer of the bank, but there are minimum surpluses that they're looking for. So if you're going to limit, or you've got limited supply, you're only going to want to lend to the very best perceived borrowers.
Yeah.
Right? If we bear in mind that these things are coming in order to avoid a property boom, just level things out a wee bit, there will become a time when servicing rates will come back and people will have this surplus, but their DTIs will fail.
Yes.
All right.
So since we're talking about DTIs, and I know you're about to launch into this example and explain it to us.
Sure.
What is debt? Explain what the banks are looking at, because I understand mortgage debt, but is there other types of debt that they're going to take into account?
Yes, for me at this stage, in my interpretation of it, does revolve around your personal debt. So your credit card limit, your personal loan, your things like that, cards and stuff, and then your mortgage debt. Now,
they're going to put that together. Are they going to bunch together all of your income as well?
Yep. So it's all going to be measured on your gross income. So in this example, if we've got a couple who are on 50K each, personal income's 100K, right? So rental income will then come into the mix, but what we don't know is how that will be scaled.
We know 30%, or you never know, do you?
Yeah, because these are Reserve Bank rules, and what we don't know is whether in calculating DTIs, bank will make up some of their own rules. So
if they took pre-tax salary and then post-tax rental income, but this it's a Reserve Bank, you never know how they're going to go. I think they all drink quite a lot, I think. Yeah.
And there's certainly some details to come through on this. I guess, and as that starts to filter in, we'll start working with our clients on sort of predicting what their DTIs look like, and what sort of effect it will have on their ability to move forward.
Yeah. So realistically, we should probably look at pre-tax salary, all rental income, borders salary, business earnings, share portfolio earnings, and bunching all of that stuff together. So I think what you're saying there, Dave, is that tonight's top tip is that everybody out there listening to the webinar should try hard to marry really well. You know, you had who has a high income, works very, very hard and spends nothing. I'm sure you're all nailing it. And then that's the figure that we multiply by either 6 or 7 to figure out how much debt we can take. And I think that's where people start looking at it and going, 6 times for owner-occupier looks good, 7 times looks better. But in my mind, 6 times is only one property you're buying once. And the 7 times for investors is the portfolio that you're trying to put together, which pushes even more importance on 2 things. One, only buying serious cash flow properties, because that's the only thing that keeps your head above water when it comes to borrowing the next amount of money. Being very, very careful of who you borrow money off, because BNZ, ANZ, ASB are kind of the easy people to borrow money off, that they're the default. But sometimes going to your broker and having a look holistically over your portfolio, what you're trying to achieve, that sometimes you look at that and go, well, look, I'm actually better to take this one to a second tier lender, leave it there for a year or 2, let it mature a little, let me do the renovation, get the rent that I think I can get, and then bring it back into the fold with the experience of your broker who does this every day and deals with all the banks. Do you know what I mean?
Yeah, and sometimes that one is something that we execute quite a bit when the client's buying a property that on settlement day is just an ordinary rental property.
Yeah.
And because the yield on it's not that great at settlement, it doesn't work with the bank.
Yeah.
But then they go about doing stuff to supercharge it. So we get in there and settle with a near bank lender, and then allow the client get capital for the client to make the improvements. Then we look to try and take it back to bank. The biggest one with the near bank lenders and that works so often is if you're carrying some sort of reasonable debt position now in your portfolio, and you're looking to buy another property, when you go to a bank for that new loan, your servicing calculation is done at 8.9% on that loan plus all the other debt that you currently have. Doesn't matter what sort of rates they're on, doesn't matter if they're interest only. The servicing calc is spread right through the portfolio. Yet with the near bank lenders, the debt held elsewhere is treated under their actual repayments.
Yep.
And that can make the difference between making a step forward and not. And these guys won't be included in the DTI calculations either. So we're going to get that again as we go through the year. And it may not be till later on in the year or even next year that these DTIs will bite. They might be introduced, but they won't bite for a while because our servicing rates are high. Okay.
And this is where your strategy becomes so incredibly important, because we could talk about tax deductibility, and having 100% tax deductibility for your new builds that return, say, 4% or 5%, whereas you really want to buy something that returns 8 or 9%, you've got to take that to a main bank. You'd kind of want to buy a new build with a second-tier lender on interest only, but that doesn't work as well. I think it's all about not eating cake for every meal, and that no one thing fixes everybody's problem.
And I think that's where we try and provide a tailored solution. Everyone's situation is different, and it's just about understanding what people would like to do, and then running the maths against that. And the solutions can be many and varied. They really can.
So I got a question here for you.
Sure.
Kirk asks, why do we need the value ratios, DTIs, and the triple CFA?
Because I'm going to try not to be flippant.
Oh, go on, do it. We're all friends.
Well, I believe in New Zealand over the last 10 years, we've just become more and more regulated in our lives in so many different ways. And this is just an example of that within the finance world, because obviously we can't be left to our own devices. And if we were, we'd be naughty boys and girls.
Yeah, but also I think that the Reserve Bank has the OCR, the official cash rate, to play with. And there's a whole pile of really smart guys with one button in front of them. And it's like, your hands are taped to hammers, so everything looks like a nail. And I think if they've got a few different dials that they can twist, They can turn things up and down. I think the Triple CFA was a horrific nightmare of a horrible piece of legislation. I think LVR restrictions actually helped Kiwis own more of the houses we've got, and it put us further away from the bust. I think DTIs, I'll wait and see how that one works out. I'm not a huge fan.
Yeah, so LVRs and DTIs, macro-prudential tools, as you quite rightly suggest, is the little tweaks that allow a little bit of control of the market. Okay.
Yep.
Triple CFA, obviously when it was introduced, was an absolute complete disgrace, and we had to go through 3 reincarnations to get anywhere near somewhere reasonable. Do bear in mind there's another one coming.
Yeah, I mean, I think
that's called the Conduct of Financial Institutions Bill. Fortunately, it looks that there was some discussion of it being scrapped with the change of government. It's still going to come in, but hopefully it will come in a way that is far less onerous on our financial institutions than it was going to be.
Yeah.
So it was like pretty much looking at it going, if you thought Triple CFA was bad, wait till you see this one. But it looks like, fortunately, that's been averted to a degree.
Yeah. I could go on for hours about how much I disagree with this amount of meddling, but let's get on to your example here. Tell us how this works.
Yeah, pretty straightforward on this one. That just owner-occupied. Say we've got a couple, 50K each, small credit card, small personal loan, and personal lending of 500K. So first and foremost, all of the personal debts will add up to give us the 520. If we've got 100K of income, we've got a DTI of 1 to 5.2. And given the guidelines that have come out, that's fine. That works pretty well. So you can do that at home, folks. You know, if you've got your own home and you know how much you have got in mortgage lending, and you know if you've got a credit card limit and things like that, you can work out your own DTI and see how you fare. So that's pretty straightforward one. Go on to the next one for us, Steve.
There is actually a really good calculator available too, but it means I have to mention OPS Partners.
Yeah, I've seen that. It's good.
It's good. Eh?
Yep.
I think it's OPS Partners /DTI, opspartners.co.nz/DTI, and they've just got a calculator there.
Yep.
Yeah, it is opspartners.co.nz/DTI, and it's just a calculator, and you put in all of your numbers, and it tells you what those guys do some great stuff, actually, some great free tools.
Yeah, they do. But you can do this on a calculator on your phone as well. Yep. So if we imagine that same couple then go and buy a 500K rental property, leveraging off some equity in the home, they double their debt position, they've still got the credit card, still got the personal loan, they've still got their personal income. And they add some rental income into the mix. Now that's not a lot of rental income, guys. But it isn't, I didn't want to be a superstar investor in this example. And what we don't know, again, is how the banks are going to shade rental income. But if that was our rental income from that property, we've then got a situation where our total debt position is just over the mill, and our total income piece has gone up a touch. A bit of a typo there, sorry. But there's a DTI becomes 1 to 8 and sits outside of the rental. Now, I think in that example, at $500 a week in rent, I shaded it by 70% or 80%. So that's why that total income piece doesn't add up correct, because I have shaded that rental income, made an estimate that the banks will do that. But the DTI flops outside of the 1.7 quite easily, just with one acquisition. What's interesting with this, though, is that wouldn't work at a bank either. All right, the servicing rate at 8.95, this particular scenario fails.
Yeah.
Okay. So at the moment, there's some equilibrium a little bit between them, but as servicing rates start to drop, that's when the DTI will drop less.
Yeah, but also the longer you own the property and the more you do rent increases and the more you pay the property down, the amount of debt's going to become lower and the amount of rent's going to come up. It's just going to be slow.
Well, that example there, if that couple would need to earn 150K for the DTI to drop under 7.
Yeah.
That's a big shift.
Let's set some quick questions here because we're rolling through them here. Leslie asks, if you're building a shed on a property with a self-contained unit to rent out, do we qualify for tax deductibility? But my look at them through the rules, if it is a new property with a new code of compliance, yes, it can be considered a new property. So that one's interesting. What else? Amara asks, when are the DTIs coming? It sounds like June, July, doesn't it, Dave?
Mid-year. Yeah, I think, mid-year, June, July. I mean, I think they're going through consultation now. It's just going to depend on how quick they can get through that and get a consensus around it. So June, July.
Yeah. We're looking to build 2 townhouses at the back, but can't borrow enough. Is it possible to take a second mortgage through a second tier for the shortfall?
Depends on how big the gap is, because if it's close enough, then potentially a different provider might give you all of it. Because the one thing that still folks don't always remember is that every bank's servicing calculator is different. Yeah. And if you just go back to your bank because you've got the connection there, they're going to use their servicing calculator.
Yeah.
Whereas another one, might work. And also with new builds, sometimes banks will have to put in different allowances for cost overruns too. So if you get close but not quite there, maybe a different calculator might work for you, mate, and obviously we'll more than happy to look at it for you.
Yeah, different being. What's the advantage of being on interest only for a longer time or even shorter time than P&I? It's just cash flow, really, isn't it?
Yeah, this all depends on your circumstances. I always look at interest only and go, if you need it, you take it.
Yeah, absolutely. It's freebie.
Yep.
Mortgage being the house price or just the borrowed amount? That is just the borrowed amount. So it's credit cards, student loans, cars, and the actual borrowed sum. So it's not the purchase price of the property. Correct, Dave?
Yeah, I've just assumed that LVRs work fine. There's plenty of equity. We just concentrated on the loan amount. Yeah.
Excellent. This is a slightly trickier one. Is mortgage interest deductibility applicable if a rental property was purchased today that is not a new build? If not, is there an expectation time where this may be restored? Now, this is a hard one because what we're talking about is interest deductibility. Now, the Labour government took interest deductibility and was progressively taking it away from us before the national government got into power and told us that they would progressively give it back to us. They're now talking about having 100% deductibility by 2026, but they're also got a discussion piece out saying that they'll give that interest deductibility back to us even quicker at 75, 80, 100, meaning that we get 100% interest deductibility by 2025 and still have 100% in 2026. So we are getting interest deductibility back. It is looking like it's going to come back quicker than we thought it was. The gotcha right now is if you purchase something right now, you are bound by the rules and the laws that this country has right now, which means that at the moment you buy something, you've got 50% tax deductibility until, oh God, help me out, Dave. I'm going to say something next year.
This is where I go. This is my department. You've got Matt Gilligan on next week.
Oh, mate, I've got notes even, and but also what they say they're going to do is different to what they are hoping to try and do. But both of those are good scenarios. Both of them give us a better cash flow later on, and there's a huge lack of detail, I suppose.
Yes, again, there's some clarity here that's got to happen, and I think we can safely say it's going to get better. It's just a case of how quickly will it get better. And I certainly think when it comes to these sort of questions, these are conversations with your accountant. Certainly tuning into your webinar with Matt will get some clarity on from his
coming up on 28th. By the way, we'll talk about that. Also, like even Jeff just jumped up here and just said, I think it's 0 right now. No, it's not. It's actually 50% right now. There's only one law in the country at the moment, but every accountant looks at every property and goes, when did you buy this? I've got a migraine coming on. Like it's hard to figure this stuff out. So talk to your accountant. Yeah. Cool. All right. Well, let's move along a little.
Sure.
So you're going to come along to our bootcamp, and we're going to talk about the bootcamp shortly, but essentially we do a one-day event. It's in Auckland. We get 350 people in a room, and every year we try to teach new stuff on new and change things in the property market and keep it absolutely fresh. And you can see from the information this evening that that's exactly what we're doing. So what are you going to talk about at the boot camp?
Yeah, look, I think Jack and I are going to be on stage together. So Jack's my son. We'll present together, which will give it a little bit of a zhuzh because he's far much younger and better looking than I am. I think what we try and do is start the presentation off by trying to get people to understand where they're at. You know, I think anytime you look at moving forwards, anytime you look at start to reset some goals, you've got to look at your starting point and go, okay, where am I at right now? And we talk about borrower types. So we want people to understand who they are in the scheme of things, because that then leads through to what they can do to change that. It leads through to the sort of funders that we can use. So we talk a lot about the connection between, you know, your serviceability and your equity and the property choices that you might make. It leads us through to what sort of properties should you buy. So all this stuff's connected, and we'll try and, you know, take the room on a journey to try and connect the dots. So by the end of it, they go, okay, I get a bit of this. So understanding your borrowing type certainly is where we kick off, and then understanding the rules of the game. Anytime you're going to, you know, we hope that, you know, heaps of people come because they want to play.
Yeah.
They want a property play. So if you're going to play, you've got to understand the game you're playing. So we'll lay out, you know, how the banks do their servicing calculators. What can you do to improve your serviceability? What sort of role do the neobanks and non-banks have to play in the scheme of things? You know, go through the whole broker toolkit so that you can open yourself up out from perhaps a narrow viewpoint of I must deal with the banks to go, actually, there's some lenders out there that can do some very cool stuff that will allow me to take another step forward.
So you're going to take an hour on stage and basically work your way through all of those with it, so that people know. Because I mean, I think most people out there think they know what they can borrow and what they can do, but really don't. Honestly, there's new stuff coming out all the time, and I think that you've even got something new and interesting to talk to us about today, don't you?
Yeah, look, we're always looking to try and improve what we can do for people. Okay, so one of the things we'll be touching on at the event is a new funding line, short-term funding line, where the product parameters have been really stretched outside of the norm, and the price.
Explain what that means. Because people sitting there going, "What's a product line? What do you mean by funding limits?" Like because I know what this stuff means, and I'm actually really excited about it. Like, this is something that you and I have been trying to put together for years and years.
Yeah, so, you know, anytime you're looking to borrow, the product parameters is going to be, you know, how much money can I get? What's it going to cost me to get it? And how much can I borrow? LVR becomes really important, right? Now, when we're looking at short-term funding, where in this particular instance, it's going to be really geared towards trading, which we think is going to be pretty strong focus in the next year or so.
Yep.
Then quite often those lenders will look at lower LVRs because they're very conscious around the security. They want lots of fat in the deal. So we've broken the ceiling on that. That's for sure. I'm not going to put a number on it, Steve.
No, it's fine. But what we're basically saying is that if you go to ANZ, you've got all of these rules. You've got loan to value ratio restrictions, you've got DTIs, you've got rules. And if you go to a second tier lender, you've got less rules, and it's going to cost you a little bit more, but you're going to be able to bypass all of these strict rules that the Reserve Bank's put in place. And what we're talking about is a totally private way of funding property deals, where one or two people have a quick look at the property and go, we actually think that's a really good idea, and we can actually internally fund property purchases for people, as in act as our own bank, which could be kind of exciting. It really could.
Yeah, I mean, and I think the key again to reiterate is it's all been done and put together in the right way. So all the boxes around, you know, regulatory and compliance requirements, all the methodology that's needed to keep things absolutely watertight are all there, and the twists come in with the pricing is less than market, and the product is better than market.
Yeah. But in essence, what we're saying too is that in a trading environment where somebody might want to go out and buy a $700,000 house because they know they can spend $100,000 on it, make it worth 1.1, and then refinance it to another bank or sell it for a quick profit or do whatever they want to do, that there's now something out there that could allow them to do that very quickly and very easily with a whole lot less paperwork and regulation and DTIs and LVRs and official, fiscal policy that could be seriously interesting to the Auckland property market. And we will be able to throw a lot more light on that at the event. And it's something that possibly the property industry in New Zealand really hasn't seen anything like it yet, which is very, very exciting. And I remember 10 years ago, you and I talking about just trying to put something like this together, honestly.
Yeah, absolutely.
It's very, very exciting. So what we're doing with that is we're going to launch that at the Succeeded Property Bootcamp, which is in Eden Park on the 17th of March, which is coming up pretty soon. This is a photo of me standing exactly in that exact same room where Dave and I spoke last year. Really enjoyed the Eden Park room. Great size.
Wonderful venue.
It's a great vibe, wasn't it?
Oh, it's massive. Yeah.
So they wouldn't let you run out with a ball and actually have to play at lunchtime. So we're going to get stuck into that. We've actually sold a hell of a lot of tickets to this already, but we're rolling through it. And obviously it's going to be massively upgraded for 2024 because it's just such a different year than it was 2023. We're that much further away from JIP restrictions and COVID and all the weird stuff that was going on. And we're so far into new lending rules and lending limits. And banks are just, the liquidity of banks feels like it's come back so far. Like banks are actually lending money again. We've got a huge number of new properties on the market this summer and they're selling. Some of you that follow my Facebook page obviously might have seen that I put up a list of $30 million worth of sales. And mostly the comment was, shit, prices haven't actually come up that far, have they? What most people missed, though, was it means that people are getting bargains. People are buying some great deals. And that's what we want to promote in this, another boot camp where people actually come along and write screeds of notes and take information away and go and start investing with it, with or without our help. And what we're trying to look at this time round is the art of transforming portfolios and starting portfolios and building portfolios. So I've been a property coach for, it must be 20 years now. 31 years ago, I bought my first property, which is funny because I'm only 34 years old. And I think that my superpower has become looking at other people's portfolios and helping them build them from property to property and going from step to step, because I worked on hundreds of them. So what we're going to really concentrate on with this event is transforming and creating a portfolio for 2024. Because I got asked the curly one the other day, if you started again, would you do it the same way? And my answer had to be, I wouldn't do anything the same. It's so different now than it was then. And we have so many more constraints. Most of the stuff we could do 30 years ago would be considered fraud today. But then there's a whole pile.
We did some crazy stuff, eh?
Oh, look, absolutely nuts. I bought houses on credit cards and oh god.
I was broken pre-GFC and we were doing 110% lending.
Yeah. Yes.
It was just crazy. And I know that I can be uber critical around where regulations got to.
Yeah, because you've been there. Yeah.
But the wild, wild west was happening back then, and it was just nuts. So there's an element of it that is absolutely keeping people safe, right?
But then on top of that, we've got a whole pile of more skills and tools now that we never had then as well, with technology as well. So it's insane. We've worked really hard for this event also to get my investor panel up and running. So we've actually brought in property investors from all around the country who are investing in Christchurch and Wellington and Whangarei and Auckland and all over the place, and getting them to sit there. And because you probably watched a lot of my videos on Facebook and you've seen this head doing a lot of talking, and it's so useful for people to listen to other people who they've never heard of before, who've had exactly the same trials and tribulations and issues and bits and pieces, and them explaining how they've put their portfolios together. We've also obviously got Dave Windler coming along to speak. And because we had him back last year and he was so good, we've actually got Matthew Gilligan doing taxes and structures. Now, taxes and structures can be slightly dry, but Matt never is, because he's a wealth of knowledge. And the reason for that is he's a very, very big property investor and developer in his own right in Auckland and also regionally around the country. And he punches his weight, this guy. So he can talk the talk as well from a position of being an investor. So big time. And that's why I've also got him on a webinar on the 28th as well, because there's a lot more information that we'd like to give you to that as well. And we will, everybody online tonight will plug you into that webinar as well. Make sure you don't miss that one. The other thing is also, we've developed over a period of time, and because the Eden Park venue is kind of out in the middle of nowhere, it's hard to get places from there to a degree. Masses of parking on a Sunday, great. Easy to get to, but just hard to get out. We're trying very hard to keep everybody in the venue for the entire day so that everybody can network with each other, because the other people that you meet at these events who want the same things you want are all there and wanting to have those conversations with you too. And I think that's a massive part of it. And that's why we've decided this year again to buy everybody lunch again. So we are bringing caterers in, and for your ticket price, which I'm about to tell you about and give you a bloody great deal, by the way, a better deal than I have ever done. I'm getting soft in my old age. Shut up, Dave. He's laughing at me again. So we're just going to put on a whole lunch, because I got hammered with questions last year right through lunch, and I got like half a sandwich. But like everybody ended up being able to just have such good, robust conversations and talk to the people around their table and take food back to their table. It just made it so much easier for us to just provide lunch for everybody. So we're doing that again at a moderately horrific price. So, you know, thank me later. The other thing that we've done specifically and only for this webinar, because we knew that the people that are logging into this webinar were specifically interested in finance and funding, is I have twisted one of Dave and Jack's rubber arms for a bit of a bonus from them to unlock the finance potential of the people that are on this webinar. We've organised a prioritised lending assessment. Now, Dave, walk us through what they're actually going to get out of this. We've got some bits and pieces, cheat sheets on the screen, but what are the investors going to get who buy a ticket to the event tonight and get this?
They're going to know where they're at before they get in the room. That's what we're going to try and commit to. Now, if there's a few hundred people that take up this offer, we're going to be stretched. But I've got a team of 25 advisors.
Yes.
So Jack, Carl, and I have been the three people that have sat, pretty close to this sort of stuff for a few years. So the three of us will work through all of those inquiries. We're going to get some information from you. We're going to take a look at your current lending position, see what we can do to improve it. We always we always start at ground zero and go, okay, what can we do better here to give you some serviceability? Take a look at what the options might look like. Can we help you improve your cash flow? What does your next purchase look like? What sort of property do you or should you buy next? Now, we can't give investment advice, but we can look at the lending and go, based on these numbers and where your equity's at and where your servicing's at, this is the sort of property that will help you keep buying for longer. So they're the sort of insights, hopefully, that will give the crew off the back of the priority review.
Fantastic. So in essence, what we're trying to achieve here for the people that are super motivated is you buy a ticket to the event, you come to our one-day event, we give you these skills in this boot camp in the room, we pay for your lunch, you do a whole pile of networking, you get a special ticket price, but you also get Dave and his team to look at the lending you currently have, tell you how much more lending you can get, help you work and play with your income to show that in its best light, and basically look at your entire holistic financial being and give you an idea of what you could afford to buy if you were out there looking. And then I'm going to stand on stage and talk to you about what you could buy and how that could impact and how you physically, step by step, get through the ladder, property ladder, to put a portfolio together that will serve you financially for the rest of your lifetime, but also give you intergenerational wealth and show you how to pass that wealth on to the next generation and to your kids, the way that I am with my 21-year-old son, who's going to be crewing the event and talking about the property that he bought last year. And as Dave is, when he comes along with his son who works with him as a mortgage broker in his business, and how a lot of our crew for the event are, who are now bringing their next generation of children along to these events as well. And I love that stuff. I think that's just
cool.
It's just such a roll on to that. It's really exciting. So we've got a special webinar offer for everybody today. And like I said, I've never done an offer like this before. I may be shooting myself in the foot a little bit, which is why I've had to limit this to 50 tickets. But what we're going to do is step one, you need to go to stevegoodey.com/Auckland and you enter the code webinar, and we're actually going to give you 50% off for the first 50 tickets, no matter what tickets you buy. So we have general admission, which is 1 ticket. We have double tickets. You can bring 2 people along, or our VIP tickets until they sell out. And we're taking 50% off all of them, half price. Now, we're going to leave that open and for the first 50 tickets sold. We can't do much more than that. So we need you to jump over there and do that like right now. We also have 2 more webinars to go. I've got some really interesting stuff to talk to you. The next webinar, which is on the 21st, we've got a special guest. Don't particularly want everybody to know who they are, but they're going to be on camera and talking to me because I made them do it. And they're going to tell you about how they've set up their portfolio over the last couple of years. These are just mum and dad investors who have done some really, really cool stuff. Now, as I said, I've got your email address and your phone number because you registered for this webinar. I'm going to pre-register you for the next webinar and the next one after that. Feel free to turn up, come along, watch it. This next one's going to be really, really good. It's basically just a case study. It's somebody who came along and said, this is what we looked like, and we did what Steve said, and then this is what happened. And it's like it's a kick in the bum for most people. It's like, this is what's possible. The week after that, as I mentioned, on the 28th, we've got the big brain of Matthew Gilligan coming along. What we're going to talk about there is how the market changes impact you as a property investor. There's been so many changes, and we want to show you how they're going to impact the market. So where are DTIs going to impact prices? Where is loan-to-value ratio restrictions and tax deductibility going to impact? What regions, what part of the market? And we're going to dig into that in a lot of detail. And Matt's exactly just the guy, but he's going to be very, very cool at that. So like, as I said, thank you so much for joining us this evening. I'm going to keep answering some questions, but what you need to do now is run over there to stevegoodey.com/Auckland, enter the code webinar, and you get a 50% off your tickets until 50 of those tickets are sold. As soon as those 50 are sold, sorry, we can't do it because we get 300 people in the room. We've already got like 100 people coming. We do 50 tickets per webinar. This is the best deal you will get on ticket prices. I've never done 50% off before. And,
You are getting soft.
I know. And I'm buying you lunch.
Is this because it's the Valentine's Day, Boxing Day, or something? You're still feeling the love?
Well, no, it's not Valentine's Day today. It's
Valentine's Boxing Day.
No, it's the Valentine's Day you have when you forgot to do Valentine's, when you hit BP for flowers and stuff. So let's hit some questions.
Sure.
Will webinars be recorded and available on demand? Probably, but it is best to watch them live because we do tend to make stuff up as we go along. And they just become a really big file and it's really hard to manage. So sometimes we can do links or put them on YouTube, but it is most definitely best to jump on these bad boys live. What else we got? What a question there. That was an answer, wasn't it? Anna's already got a ticket. Yay! Can't wait. Looking forward to see you there.
I like Candace's question, Steve. Will the boot camp benefit me if I have absolutely no idea about investment property, but I'm wanting to start? Heck yeah!
I don't even know where that question is, but yes. No, look, we talk about a lot of different things at these boot camps. It's not terribly complex information, but what I pride myself on is that it's grassroots information. Myself and all of the people that crew these boot camps, who are people that have been around me for years or current clients of mine, they donate their time to help other people, to show them that it's possible, because they were sitting in that room a few years before trying to figure out whether it was possible for them or not as well. And it's hard. Like, I'm not gonna sugarcoat it for you. Buying 10 or 15 rental properties in your lifetime is really, really difficult, but it's bloody worth it. And there's just so many gems that you can pick up. And a lot of it will be me standing on stage, doing the God pose and walking out on the T stage and telling you about some big stories and pointing at the screen behind me. But a lot of it's going to be the person sitting next to you is going to share a story over lunch and go, oh, I went and talked to Dave and I didn't think I could actually get finance. And he pulled a property up, made it freehold, took it to another bank, and they gave me 600 grand. And I took 300s and bought 2 properties and renovated one and sold it for profit, kept the other one. And look at me now sort of stuff. And that stuff resonates with people, because you can watch a million of my videos, but you get in the room with me for a day and I'm confident that I can change your life, because I can say that because I've changed so many other people's lives. And I go back to remembering a client of mine that I worked with 9 or 10 years ago who came to me in tears and said, we bought our first rental property. It's about $100 a week cash flow positive, meaning that it pays them $100 a week after all costs and expenses. And she was just blown away because she could spend $50 a week more on food every week after that. Just a tiny little thing. We're not talking Ferraris and holidays to Hawaii. We're talking people who have just nailed a system and got off the first rack and done something and are so proud of themselves financially for doing that. Because, my mentality is that we all work really hard at whatever it is we do during the day. We really do. We work hard to pay tax and have some income left, and that's the seed capital. And it's what you do with that seed capital which makes you wealthy after that. Because nobody saves themselves to being super, super rich. You invest and you create wealth, which creates more wealth. And that's the way that you do it. Okay, so what other questions have we got here? Kurt asks, what does VIP get you? Good question. You get into the room early and I'll come and have a chat to you. And last year there was, 30 or 40 people in VIP, and I went in there with a cup of coffee and answered any questions we had for 10 or 15 minutes before the event started. The VIP section sits right at the very front, so you're the first ones to grab freebies and hand stuff to the speakers. It just can be quite good. You get cold water and some extra food and some lollies on your table, and you get treated nicer. We're not as mean to you. Now,
Goodey back.
Freebies and better stuff. You get to sit right.
Yeah, we ordered our freebies for you today, Stevie. They were there.
Love it. We do a lot of extra bits and pieces for that sort of stuff as well. So you get a lot more bits and pieces there. Christchurch for life says, can you do another one in Christchurch this year? Because we did do one in Christchurch last year, and honestly, I was talking to Dave about this before the webinar. Half the people flew down from Auckland. I would love to do Christchurch again, but these events are so expensive to put on. You're talking well over $100,000 to put these events on, and they just don't make that much money. So you've got to be a little bit conservative. So I'd be really keen, fly to Auckland, come and see us up in the Big Smoke. We'll get a big room going, and we'll go from there. Another question is this going to limit purchasing power of first home buyers, and what impact will it have on the property prices? Great question. I think it's going to limit investors before it limits first home buyers. Personally, I presume we're talking about debt to income ratios, and I'm going to dig into that on the 28th a lot more with Matt Gilligan, who is closer to an economist in his mentality, I imagine, than I am. And he has an annoying way of nearly always being right with predictions about this type of stuff. So I will register you for the webinar on the 28th. Come along to that one as well. Real interesting, and grab that ticket. And Dave just grabbed his tickets. Excellent. Great to see you coming along. Half price off on the double tickets makes them really economical for 2 people to come along as well. John says, awesome. Bought a double and I'm a cheap lunch date. I have been called worse. But thank you for that. You haven't seen the lunch yet.
The food's good.
Pretty good last year, wasn't it? Yeah, very good. You got to eat some. I was flat out. Yeah. Excellent. What other questions have we got here?
That question around first-time buyer borrowing power, I reckon the key with that is all of a sudden first-time buyers now get a 20% speed limit.
Yeah.
So I think they'll be all right.
Yeah, but that LVR is going to be relaxed as well, and I think the government wants to limit investors, promote new builds, and not ignore first-time buyers in that order, probably. So, yeah.
Banks got to have some confidence in the market, mate. One of the big four came out suggesting that within the next day or so, they're going to go to a 95% off rate.
Yeah, and I mean, second tier will beat that anyway because, the funding market is just a market. If there's $100 to be lent out, $99 has to be out there working at any one time. So banks aren't there to hold money. They're there to lend it.
They want to lend.
They'll adjust it any way they can to get market share so they can pay dividends to their investors. That's just the way it works.
Yeah.
Yeah. Thanks. Got my ticket. See you there. Oh, somebody's jumped on there and gone. It's possible the VIPs have sold out. I honestly haven't had a look, but yeah, I imagine there's a lot of people jumping in there because we have never done this pricing before. Actually, it's probably going to piss a few people off, but we're here to break a few eggs, make a few omelets. Just bought a double. Yay. See you there. Late Valentine's gift for hubby. Oh, it's so romantic. Looking forward to it. Great to see you there.
Good question from Shaz.
Yeah, I'll bang that up. You go. Do it. Oh, did I? Yeah, we're all pressing the button.
I'll do this one. Okay, so this one, speed limit is looking at if you've got a DTI for investors of 7-1 and banks are lending within that DTI parameter, they can lend 20% of what they do below the parameter, above the parameter. So whatever they're lending below a DTI of 7-1, they can lend 20% of that above 7-1. So they'll put in a layer of their own criteria to decide who they lend that to. But yeah.
See, I would love to put a calculator up on my website and get a really good cross-section of investors to go in there and do their calculation. And I'd just love to know if it's actually going to affect that many people. I don't think there's that many people that are actually maxed out on their lending. What do you think, Dave?
Well, yeah, there's plenty out there that have got capacity and they just haven't found it yet, because quite often what we find, Steve, is that people who've owned property for a wee bit of time, they've dealt with their bank for a wee bit of time, they just haven't looked around enough.
Yeah.
They've actually got more capacity than they think they have because they just haven't had it looked at.
It's the same thing as people coming up floating and they don't ring their broker when they come back to refix. They don't get any options. They don't ask for the advice of the person who's free to them and being paid to give the advice. Yeah. What do you think of this one?
Look, I think, Shaz, it's a great question, and I think the key there is you've got to have strength in that portfolio that when the servicing is going to work. So I think the battleground will be to be making sure you're amongst the 20%. As servicing rates get lower and the DTI calculation takes more effect, it's going to be a fight to who's got the biggest surplus and will lend to those people. So that's what I would be thinking around right now. If you're looking at your portfolio and thinking that your DTI is up there a little bit, and then it's all about the other parameters so that you can get in amongst the exemptions.
Yep. I've just had a look online too, and we do have VIP tickets still available, so they're not sold out. So if you're having a struggle there, jump back in. They are still available. There's a lot of people on there at the moment grabbing their tickets because we have honestly never done this before. So, obviously do that. Dave, how quick are banks putting pre-approvals through at the moment? How fast are they moving?
Reasonably quick at the moment. I mean, that time to approval is always impacted by volume. At the moment, volumes are reasonably light, so approval times are pretty quick. So I think once we've got all our documents in from a client, we'd be expecting 3 to 5 working days at the moment. And it can depend on the bank, but that's a bit of an average bit of feedback for you.
Cool. I'll give Carl a call tomorrow then.
Not your stuff, mate. Your stuff takes a long time.
I know. Oh, man. I think it was 900 pages this time, my application.
Yeah, that doesn't surprise me.
Simon says we have multiple rental properties with good yield. Is it sensible to sell to pay down our owner-occupier new build outright, which is nearly complete, or just have a large personal mortgage to service?
Really hard to answer that without a heck of a lot more information. And it would be bordering on personal financial advice. I think I'm going to fence it on it and go, Simon, it really depends on how you feel about your cash flow. You suggest your rental properties have good yield. If they're good performing assets, it's then about your personal income and your ability to manage the mortgage on the owner-occupier to the degree that you're comfortable.
Yeah, absolutely. I mean, I would look at this question and go, figure it out both ways. But if you paid off your owner-occupier property, are you just going to then go and invest again anyway? It might just be a matter of reorganizing your funding so you have a very, very small mortgage on your owner-occupier property and some mortgage on your rental properties that are paying themselves through the rent. But take a look at it both ways. It could work. And then go and see your broker or go and see Dave or one of his crew for some advice and some backup thought. Great that you're thinking that way, though. I think that's the thought process is great. Message here from Christine. Yep, no problem. I'll sort you out. Email me, send me a message. We'll sort that out for you. No problem at all.
Our Christchurch friends asking about TSB, Steve.
Yeah, do you want to answer that?
Absolutely, yes. You just got to ask nicely. So what we found with TSB within the and this is where we're at the coalface. So this is within the last few days. What they're doing is they're pricing very, very keen on new business and not so keen on refixes. So you have to smack them around a bit on the refix to get what they're offering new clients. So definitely under 7%.
Can you still put a shot across their bow and ask for a cash out figure? Does that still work?
They won't do it, but one or two others will.
Yeah. Cash out figure, for those wondering, is when you go to the bank and say, well, what are you going to charge me if I just take all of this lending away from you guys and just put a shot across their bow to a degree? Worked back in the day, but take Dave's lead on that one for sure. What else we got here? What sort of properties will be classed as own good properties for long term? Another hard question to answer. It comes down to what your portfolio needs, in my opinion. I believe portfolios are a bit like souping up a car. They either don't have enough fuel or they don't have enough air. The fuel in the air is either equity or cash flow. And so it comes down to what does your portfolio need to grow? I also look at portfolios, and a lot of people think that growing a portfolio is a bit like Monopoly. More is better. Not necessarily. Every property in your portfolio has to have a reason for being there. It has to be doing something positive for you at the time. So that's my easiest way of not answering that question. Good question here. How do we book in the prep session ahead of the workshop? If you have purchased a ticket to the event tonight, and we're not quite at the 50 tickets sold yet, but we're definitely at 30-ish, then we will send you out an email and get you in touch with Dave and one of his advisors before the event, and then it'll come down to how many late nights Dave wants to do with all his crew to sort of get through and how many people end up throwing at him in this great hospital pass, because I just love it when, Dave does all the work. Next question from, thanks for the previous answer, ANZ, hard to get money out of ANZ for a first home buyer? What have you found, Dave?
Not if the numbers work. And so many times, if someone's dealing direct with the bank, we go back and get the job done that they couldn't get done direct, because we just present the application in a different way. So hard to know why without the details, but as a general comment, it should be as easy or as difficult as anybody, depending on your situation.
Excellent. Well, here's a hospital pass of a question for you from Jordan.
That's why I'm not going to answer it. It's your job.
Come on.
Boomerang that back. I don't know. I'd be taking a guess at it, because obviously, you've got to you look at a gross yield situation, and you've got to net off all those expenses before you're probably that's then got to take care of a 6.89 or a 6.99 interest rate. So it's got to be a 9, doesn't it? Gross 9-ish. What do you got? Well, what do you reckon?
My position is, if you're borrowing the money at 7% and your property's yielding 6%, it's costing you money. If you're borrowing the money at 7% and it's yielding 7%, it's still costing you money. It's costing you rates, insurance, and management and maintenance. So I think that a property is cash flow neutral, meaning that it doesn't cost you and it doesn't earn you money if it's yielding 1.5% more than the finance is costing you. I think most expenses cost you about 1.5%. So use that where you will. It's obviously slightly more expensive in Auckland because you're going to pay for water rates and, like stuff like that. But, I've got clients at the moment who came to me week one and said, I've found this property that's doing 8.5% in the regions, and I think it's bloody amazing. And I made them throw it away. I've also got clients at the moment who just bought me a property that's going to return 17%. Now, it's not a normal asset. It's not a 3-bedroom in the suburbs, but it's possible. And what we do is put people into peer groups in a room with people who believe that 12 and 13 and 14 and 15% returns pre-tax are possible, and they are finding them and they are getting them. And they don't necessarily have to be nuclear silos and car parks and boarding houses. They can just be unusual properties, and they also are sometimes wrapped up in quite a bit of hard work. So if you're not afraid of that, grab one of the last remaining tickets, come along and listen to us for a day. It'll be very, very much worth your while. How do banks determine those investors that are willing to put into the bucket of loans that exceed Reserve Bank guidelines for LVR and future DTIs? Yeah. So what we're saying is that the banks can write 20% of their business outside of those rules. How do the banks decide who gets those?
It'll be down to servicing.
Yeah, because what really cash flow servicing. Yeah.
So what will happen is as test rates come down a little bit, you may fail the DTI measure, but your servicing from the bank's perspective and your surplus is good. And that what they'll do is they'll put a benchmark in play and go, if your surplus is above this level, we may consider lending. I think I'm guessing at that.
Be a unicorn.
Absolutely.
Well, this is why I must admit I push against people who want to grow a portfolio over 4 or 5 years. They don't want to take 10 or 15 years, and they're buying 4 and 5% returns because they're brand new, so they'll have low maintenance. Well, I'm sorry, but I've got a whole pile of really old houses that I've renovated that have 9 and 10 and 12% returns that have low maintenance. Yeah. Thoughts. This is interesting. Like, applying for loans, 3 people, one is on ACC payment last 2 months, at the moment trying to get approval from BNZ. The other problem you're going to have here with DTIs too, in my opinion, is offshore revenue. Not necessarily people who are, like FIFO workers, fly in, fly out, like mine workers in Australia, but people working for offshore companies. And traditionally, banks look at that income. Even if you live in New Zealand, but your income comes from offshore, a lot of the banks are going to shave that income by down to 70% or something. They're going to have some trouble, Dave?
Yeah, I think the gross income figure will be calculated in the same way that it is now. So one of the big points of difference between banks is how much they showed overseas income by. ASB made a change a month or two back, and on Australian income, it's only 10% now. That's good.
Yeah.
So we know this stuff. So we get a client with Australian income. That's where we start looking first. So I think the income will be treated in the same way. I mean, you could also sort of think around overtime, commission, all those variables, I think, will be calculated in the same way, but at a gross level, to help you figure out the DTI. Hopefully the Reserve Bank doesn't dabble too much into what income is allowable. Because this is the whole thing. I know Matt's pretty hard on this. Our banks have been very, very robust with how they lend for quite some time.
Yep.
And I would argue that these things aren't even needed.
True. Okay, one last question and then we'll bail. Does your whole mortgage on one property need to be one bank, or can it be split between banks? Pros and cons, please.
One mortgage, one security. So when we talk about a mortgage, we're talking about the security that the bank takes over the property. So if you're with ANZ and your home lending is with ANZ, that's the only mortgage that you're going to have. Where we look to split bank is where you've got some equity in your home with ANZ. We go to ANZ to borrow the 35% that we currently need. But when we settle on the investment property and we allow a mortgage to be taken over that property at 65%, we'll look to do that with a different bank. And there's the only con in that is that you've got 2 logons to your internet banking. All the rest are pros. I'm pretty hot on that one
Yeah, I like that.
for a whole heap of reasons, and we'll talk a bit about this on the at the boot camp actually, Steve.
Yeah, no, I love that. Yeah, basically what I got from this conversation tonight, Dave, is look, talk to your broker. You guys have got so many more skills and tricks and things up your sleeve that the layman or even I, who've been doing this for 20, 30 years, just don't understand. Yeah, you got to talk to your mortgage professional and get what's in their brain out of it.
If you're currently using a broker, get back in touch with them. Get them to really look at your situation. If you're not, feel free to talk to us. We're here to help.
Yep.
Absolutely.
Yeah, excellent. All right. Well, look, we're going to call it there today for this evening, guys. We have, I was looking at these tickets, I don't know, 10 or 12 tickets still available. Are they 50% off before we cut it out? So I'm going to leave that on for another, let's call it 30 minutes and let you guys grab those last few tickets. We're going to pull the webinar for tonight. It's been on here an hour and a half, which is pretty good for a 40-minute webinar. Last, just like to thank you, Dave, for with your awesome comments and the prep for this, and just being a good bugger generally, and look forward to doing the event with you on the 17th of March in Eden Park in the Grand Room, and looking forward to seeing everybody on the webinar tonight for next week's webinar, where I bring in this mystery investor who's going to show you all of these great case studies, and then again on the 28th for Matthew Gilligan, which will be more of a holistic market update on new rules and where you should be investing for making money and really great stuff. So we're going to leave the last of those ticket numbers up there. All you got to do is, as I said, go to stevegoodey.com/Auckland, enter the code webinar, and you get 50% off any of the tickets you want. I'm looking at it now, and we still have heaps of general admission, of heaps of double tickets, and a few VIP tickets still available for the event. So jump in there now. You'll probably be able to go for another 30 minutes, and we'll pull that one. And we'll see everybody on next week's webinar. Thanks for being on time. Thanks for such great questions. Thanks for keeping it really interesting and keeping us on our toes. And thanks again, Dave. Appreciate your time very much.
See ya.
All right. Thanks, guys. Bye.